Why use TurboTax when the free direct file tax return system exists? 1. The breadth of business coverage. Direct file only handles simple math. If you have stock/crypto trades, rental income, Schedule E, self-employed/freelance income, Schedule C, or require complex itemized deductions, direct file currently lacks full support. TurboTax supports nearly all complex financial scenarios. For Americans in 2026, the gig economy is ubiquitous. Even a small side hustle can lock you out of the government's free system. For this demographic, TurboTax is a near necessity. 2. Data friction. Manual entry versus one-click import. Direct file requires manual input from physical or PDF W-2s and 1099s. This is slow and prone to error. TurboTax. Its core moat is ecosystem integration. It automatically pulls data from thousands of banks, brokerages, for example Robinhood, Schwab, and employer payroll systems. On average, a user with complex income pays approximately $150 to trade for 10 hours of free time and the psychological peace of mind of 100% accuracy. 3. Incentives. Tax maximization versus mere compliance IRS stance. As the tax collector, the government's goal is compliant completion. They have no incentive to proactively find loopholes to save you money. TurboTax stance. Its business logic is save you money. Its AI, Intuit Assist, scans data to remind you of missed energy credits or deductions. Users feel that paying $150 to get $300 back while saving hours of work is a winning trade. 4. Outsourcing liability. Who stands by you during an audit? Direct file. If you make a mistake and the IRS audits you, you are on your own. There is no after-sales defense. TurboTax offers audit defense and a 100% accuracy guarantee. If you are audited, Intuit provides experts to handle the communication. Why not just use a new large language model, LLM? If a general AI, like Gemini, calculates your taxes incorrectly, Google won't pay your fines or provide a lawyer for an IRS audit. Furthermore, using Gemini requires manually uploading thousands of sensitive private files. Most people are comfortable letting Intuit, a professional financial steward, see their books, but are hesitant to hand over total financial privacy to an omniscient search engine model. In a field where errors lead to bankruptcy or jail, the psychological need for human-backed accountability outweighs the technology itself. Gemini provides explanations. Intuit provides a liable party. Why INTU over other competitors? Can't they use AI too? The data moat. AI relies on training data. While Xero or H&R Block have AI, Intuit owns the complete loop. QuickBooks, accounting plus TurboTax tax plus Credit Karma, credit plus MailChimp, marketing. Human capital density. Small AI fintechs lack offline support. H&R Block has physical stores but lags in digital integration. Intuit has built the world's largest virtual expert network. In 2026, their AI matches you with a human CPA in seconds based on your specific complexity, for example, crypto or gig work. Next-gen agentic AI. Competitor AI is mostly passive, Q&A. Intuit's Gen OS-driven agents are active. In QuickBooks, the AI proactively identifies cash flow gaps for next week and drafts a financing application or reminds late-paying customers automatically. Switching costs. Ecosystem lock-in. For small businesses, once your accounting, payments, and marketing are all in the Intuit funnel, the cost of migration, not just in money, but in data risk, is prohibitively high. Conclusion. Moat shrinkage and valuation adjustment analysis of the three killers, free direct file, general AI, and direct competitors, suggests Intuit can defend against AI and peers, but it will lose market share to the government's free system. Revenue risk. If direct file evolves perfectly, the direct revenue loss is estimated at 10% to 15%. The consumer group accounts for approximately 24% of revenue. Of that, 30 to 40% are simple W-2 users, the primary target for direct file. Pricing power. Even if only 10% of users leave, the remaining 90% may use direct file as leverage to resist price hikes. The era of 10% annual price increases is likely over. My take: Intuit will hold its moat, but must accept a shrunk territory. The valuation should be re-rated from a near monopoly to a niche market leader. A 20 to 30 times PE is reasonable. Anything above 30 times is overvalued. Direct File will eat the least profitable, simplest, low-end users. Intuit's strategy is clear. Let the government have the low-end market while using AI and expert services to monetize high-value users. Risk warning: if the U.S. ever implements a return-free filing system where the government simply sends you a pre-filled bill, Intuit's moat will collapse overnight.